Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday ETF Report, May 2nd, 2026, the beginning of a new month, and happy spring out there, folks. And remember, if you want to walk on this beach like Jimmy Buffett used to do, you've got to learn how to invest even better than Warren Buffett does now. And let us look at the QQQs. And folks, right up here, we thought we were going to get a little topping action here, which we may still yet. But the market did go down for one day in here, and it's been up for 3 days in a row. And I'm recording this on Friday around noontime. So we mentioned once before that we have all three moving averages pointing in the right direction, which is up. So this is the 20-day moving average here. And we were talking about a reversion to the mean of this 20-day moving average. But boy, oh boy, it's market just doesn't want to stop in here, as all the big names came out with good earnings. The only thing is Meta said we're spending more money. AI projects, and therefore the market said, oh, it might be a little too much, and so they took a little bit away from the price on Meta for a day or two. And down here you have the 50-day, and the red line is a 200-day moving average. They're all in the right order. And down here we see that the upward volume is starting to dry up. It's been less and less on every rally. And that's why this indicator all the way up here is showing a little topping action. And down here, we're very much overbought, and we really thought it was going to turn over in here. And I really think coming up this coming week that we will see a little flushing out a little bit, at least to the 20-day moving average, which could be quite a move in here. And it'll scare some people. But the 20-day moving average is still moving up. Don't forget, it's 20 days of average. So a couple of down days doesn't turn it around. It just might slow its ascent. So this ascent is really something. This has been some rally in here. So that's where we stand right now. We'll wait till this coming week. But right now, everything looks good. The economy looks pretty decent in here, except for the price of oil and the price at the gas pump, of course. But besides all that, the market seems to be looking past that, as are the foreign markets, and saying we don't think this is going to last too much longer. And I'm talking about the Straits of Hormuz and how it's blocked off right now, and very few ships, if any, are getting through. And let us look at the year-to-date for the QQQs, and that's the NASDAQ 100, of course, and it's up 9.5% as I'm recording this. So we see the same rise. This is the same chart, really, and we just want to show that the year-to-date we had this topping action in here, and boy, it broke right through that, and it never looked back except for a couple of days in here. Very good rally going on in the NASDAQ 100, up 9.5%, and that's up almost twice as much as the S&P 500. In fact, we can look at that right now. This is the year-to-date, and again, the semiconductor leads because all year long it's been energy and oil and gas, and right now oil and gas exploration is in second place and energy is in third. And finally, the semiconductors broke through about 2 weeks ago, almost 3 weeks ago now, or this will be the third week, that it is in the top spot, just hot as ever. And if we look down here, we're looking at the S&P 500 up 5.8%, the QQQ's up 9.58%. So not quite a double on the S&P 500. Looks like the home builders lost a little from last week when we went over this. And of course, all the way down here, we have healthcare down 5.5% or so. This is year to date. Remember, let us look at the past week. Past week, Exxon oil shot up, and there it is again. Energy right behind it. And down here, we have the NASDAQ 100 over here, and the semiconductor is in fourth place. Consumer staples did well this past week, and the semiconductors right behind them. And all the way down here, home construction lost 3.8%, almost 4%, because interest rates went up as the price of oil went up. So both home builders and home construction, which had been positive for the year, are now at least for this past week, are down at the bottom of the pile, as well as gold. But here's something I want to bring to your attention, because this is what the question was asked me this past week. What about Cathie Wood's and her ARK Innovation ETF? Remember, it was a hot stock, or I should say ETF, about 5 years ago. And this week it's down 1.23%. Let's go back to the year. And down here for the year, it's down 1.77%. So let's look at the ARK for over this past year, and we can see, yeah, it's been having a hard time in here. Not bad, because you've got this in here. We actually started here, and we're down just 1% or so. But here's something I want to show you. I went over the stocks that she has in her portfolio. Now, here's the problem. The problem is that she will trade during the day. So just because some of these stocks are weighted the way they had them as of 2 days ago when I got this chart, they have changed since then. But had she put an equal amount of money in this present portfolio, she would be up 5.5%. But because she doesn't weight them equally, she is down for the year, and this is for the year, she is down for the year about almost 1.5%. So it does equally weighted work all the time? That I can't tell you for sure, but it works for us very nicely. And people say, why do you equally weight it in money rather than equally weight it in shares? And that's because if you equally weight it in shares, you're going to have $1,000 stock versus a $50 stock. And if you put an equal amount of shares, then the $1,000 stock is going to have much more weight in that portfolio. And since we don't know which stocks are going to perform well in any coming year, then, I mean, look at Tesla down here. Tesla was such a hot stock, and now for the year it's down 14%. So you can't tell all the time. Even Meta's down 7.25%. So yeah, you have a lot of stocks that will work very well one year, and I'm talking about good companies. So overall, they're going to be good companies and have good performances. But in any one year, you don't know whether they're going to be good for that particular year or not. And so anyway, in this case, if she weighted these stocks equally, she'd be up 5.5%, which is about what the market is right now. But right now, the way she has it weighted, she's down about 1.5%. Now, here is our tech ETF. I shouldn't say our tech ETF. These are the top stocks in our tech, or out of the tech ETF. So we picked the top stocks. We are up 19.77%. Now, the tech itself, the XLK, is up 12.45%. So it's doing very well. But our top stocks, not counting the XLK, are up 19.77%. So our portfolio is doing very, very well. We're happy with that. And let us look at 5-year returns. So the ARK, Cathie Wood's ARK ETF, is down 30% over 5 years. The S&P is up 82% over 5 years, and that's on a compounded basis. The XLK, so the tech ETF, up 132% over this time period of 5 years. And our top tech stocks, our portfolio, and we do change 1 or 2 or 3 stocks in that portfolio each year, up 285% again on a compounded basis. So the top stocks again are outperforming the ETF itself, and that's what we found with all our research and all our actual portfolios. If you pick the above average stocks, over time you will very probably outperform the lower average stocks in that ETF or that index. So why not develop a strategy where you can pick the top stocks? And how you do that is what our clean surplus methodology is all about. And here is 10 years. So let's see what happens over 10 years. Black line is the S&P 500. The red line is Cathie Wood's ETF, the ARK. And you can see how hot it was at one time. So if you're only taken 5 years, well, then you've got this loss, because this is about 5 years in here at this point. So 5 years she has lost money, but over 10 years she has actually gained money, gained more than the S&P 500. And this is the XLK, so the tech ETF. And then if you picked our stocks over 10 years, we're way off the chart up here at the top. And those would be the top stocks in the XLK that we picked. That we just showed you we're outperforming. Let's go back to that. Outperforming over 5-year returns. We are tripling the S&P and many, many more times more than the ARK fund, because it had its heyday about 5 years ago. But the top stocks, if you know how to pick the top stocks, you will probably almost always outperform that ETF or that index. So, folks, we had a pretty good week this week. We had a good month of April. We're heading into May on a good note. And you go out this weekend, forget all about the market. And, folks, be with your loved ones. Most of all, stay well, stay safe, and we will see you back here in a couple of days.